office in my home. This is Phil Atwan with Exchange Resources, and I'm really happy to be with you. We've been doing these Zoom presentations all over the Southlands to different real estate associations. We've been doing it for a lot of office meetings, and I'm really honored to be with you in this forum. Everything seems like it's upside down compared to the way it was a month and a half ago. When we got off the plane back in the beginning, like the second week of March, from our vacation in Hawaii, I thought we were going to go back to what we normally do. Wow, has everything changed? Which tells me, and this is for you and for me, we have to continue to look for new ways to adapt. That doesn't mean we change everything, because I don't like change. I don't know about you, but I hate to change. But I do have to continue to adjust. And as I adjust, I'll find new ways to get in front of people who hopefully will need my information that I could offer, my knowledge of this information. And I hope the same thing's going to happen to you with your client base, that you will find new ways to reach out and connect with people. That is something that we never really have done before, but it's the transition that we need to make to be successful. Did you know that 80% of everything you do is going to be based on just showing up? Most people don't do that. You know that 80-20 rule, 20% of the people make 80% of the money? Do you believe that's true? You know, some folks says that's not true anymore. It's more like 10 to 90%. If your desire is to grow your percentage of the marketplace, to create additional business for yourself, because this is a business, the bottom line is you have to show up, which means we all have to work. We all have to put in time, and we have to find new ways to communicate with people. And what we do is we find out new ways to find people. And the other thing is, if you think about this, and I'm going to talk about all this today and how to do that. I'm just not going to throw general thoughts out there. I'm going to get specifics that I think can make a difference in your business. The second thing is that you just got to show up. You've got to find out what's important to them. And we know what's important to people who own rental properties today. And we're going to talk about that. And you're going to be able to get right to the heart of why they bought the property in the first place. See, the beautiful thing about working with an investor owns multiple properties. They don't own one. Yes, they own their home, but they own other types of properties that generate money. And we're going to get into the heart of that and how you can communicate with those folks to be able to specifically talk about what's important, not to you, but to them. And the more we can talk about what's important to them, the more we can begin creating a relationship. You got it. A relationship, because you and I both know we're not in the sales business. We're in the business of creating new personal relationships with people, because that's what creates new listings and new sales. I'm absolutely convinced of this because I've been doing first I was with the title company in 1982, and then I transitioned into the exchange division in 1998. I've been doing exchanges and calling on real estate people and escrows and title and CPAs and attorneys. I know that what matters is creating new relationships where people can call you, talk to you about what's important to them, and you can even initiate those kinds of conversations. The great Wayne Gretzky, if you've ever heard me speak, I like to quote him. The great Wayne Gretzky, you know, where you have right next door to you, where you have the Kings, you know, and all that. He said that the key to success is not skating to where the puck is. That's what most hockey players do. They skate to where the puck is. The goal is to skate to where the puck is going to be. You have to look a little ahead. And that's exactly what we're going to be talking about today. Where are investors going? Why are they interested in 1031 exchanges? Why is it that they may not be? Why is it that they should be? And we're going to talk about things like that. So you'll be able to utilize the chat room. Nikki's going to help out with that. And I thank you, Nikki, for all your support to make this morning happen. But the bottom line is you can ask your questions like we would normally, except we have to type now. But look forward to sharing with you and our 2 hours together. And hopefully it's going to make a difference in your career. The goal is just not just to get education. It isn't. The goal is to create new ideas to implement in your business. So as you show up, you will be a difference maker. And that's what I hope to do for you today. So here we go. If I can find my mouse, there it is. First question I'm getting now, before we go into anything, what I just talked about. Let's talk about what people have been asking me that you may already have the answer for. And the question is, has the IRS created extensions for the 1031 exchange? Because we know that they create mandatory deadlines that you have to keep. So what happens is, I wanted to share, you may have been watching my Facebook feeds on this, as we've been trying to wait to see what the IRS is going to do, or the Instagram or the LinkedIn, and you're always welcome to join any of those, because I try to keep you up to date. Not too much information, that overload is no good, but just to keep you up to date. So many people are confused by what the IRS said. I was confused when I first initially read it, but eventually we kind of sorted it out and we simplified it. And how the IRS came out with this extension, I think has something to do with, how they extended your tax return filing. It's normally April 15th, but because of this COVID thing, they changed it to July 15th. I think they were thinking about that when they created this, this extension. So let me show you how it works. I want you to paint a window. I don't know, I don't see your screen, but my screen shows my picture and it looks like a window, like I'm looking through a window. I want you to look at a window. The beginning of the window is, if you look on your screen, April 1st. The end of the window is July 14th. So if your 45th day to identify your replacement property is April 1st through July 14th, that's the window of time that the IRS will give you an extension. Not a closing, or not a 45th day before April 1st, and not a 45th day after July 14th. Only during that calendar period. If that's the case, and your identification date, you have 45 days after your sale is closed, lands in that window, your new identification date will be July 15th. It's the next one in green, July 15th. That's your new identification date. So if you close, if your 45th days between the 1st of April and the 14th of July, your new identification date is July 15th. Some people are going to get one extra day of extension. Some people will get a couple of months. Some will get nothing. So that's how it works, and that's how the identification extension works. Then other people say, well, what about the 45 days? Do I get a extension? I'm sorry, on the 180-day closing. Can I get an extension on the 180-day closing period? The answer is yes. It's the exact same window. If your closing date, your 180th day, lands on April 1st through July 14th, your new closing date is, I bet you know now, July 15th. That's what you get. So if your closing date was March 31st, you don't get it. If your closing date is July 15th, you don't get an extension either. Only extensions through that window. All right, so that's really the crux of what they came up with. It's very unusual. I've never seen the IRS give any kind of extensions that look like this. It's usually 90 days or it's 180 days per identification and per closing, but they didn't do it that way this time. Why? I guess the reason that they can justify to themselves, not necessarily I can justify, is because they felt that everybody is somewhat affected by it, so they blankly gave it to everyone. Whereas when they normally give an extension, like with the fires or earthquakes or something that they will deem to give an extension on, it's only for affected parties. So they decided to give this to everyone, and that's kind of the thing. So Nikki, I noticed that there's some chats coming in. Please type in your questions. Oh, okay. Does that mean it starts at the close of escrow and not the opening? Remember, I think the question that Suzanne just asked for are asked about is regarding, remember the close, the 45 days and the 180 days begin when? At the close of the sale at escrow. So when escrow closes, let's say escrow closes today. Today is the 17th of April. That means the 180 days and the 45-day period begin when? Tomorrow, the 18th. Tomorrow is day one. 45 days to identify, 180 days to close. What the IRS is saying is if that 45-day date lands between April 1st and July 14th, your new identification date is July 15th. If your closing date lands between April 1st, 180 days, between April 1st and July 14th, your new closing date is the 15th of July. I hope that helps, and I hope that clarifies your question, and I hope it gives you the answer that you're looking for. If not, we'll try it again and give me a call. By the way, when this is all over today, I'm going to leave my email on the screen. You can email me if you want the marketing materials and you promise to use them. I'll be happy to give them to you. If you want to call me, you can do that. My phone number will be on there as well. I didn't want to plaster it over everything here, but I do want to make sure that you have access to me if you have any questions, because I'm happy to do that, and there's no obligation, so it's my pleasure. All right, so that's the extension. That's really the crux of it. Now, let's go back to what's important to the investor. What's important? What makes them tick? Why would they want to talk to you or me? The answer is because we want to talk directly to the motivation, the purpose for them buying the property. And ultimately, they may not know it at this point, but the purpose for selling the property or refinancing the property, take out equity to buy more. So we're going to talk about that right now. Number one motivation is cash flow. They want more income. You see, you and I buy property. And by the way, I hope and I pray that you are buying real estate for yourself, investment property. Why are you working so hard to try to make other people more profitable and not doing it for yourself? It doesn't make sense. You're in the business. You and I need to own more investment real estate. Why? Because of cash flow. The more doors I have, the more I get paid. I don't know if anybody you know has gotten a stimulus check, but this is your stimulus check, but you get it every single month. Think about that. You get a rent check. You pay the mortgage, you have expenses, the rest goes to you. And that goes up over time. You get just automatic raises because rents go up over time. But it isn't just cash flow, it's the rate of return. What is the rate of return on the equity that's in the building? We'll talk about that in the next slide. But the bottom line is that if you have one door, like a condo or a single family or a single commercial building, you know, with single tenant, you get a paycheck every single month. If you want to get a paycheck every week, what do you have to do? You don't put a gun to their head. You don't radically raise the rent. You have to have 4 doors. So you get one a week. And many investors want a paycheck a day. And that means they get what? 30 doors. That means every day they get a rent check. Every month they get 30 pays, 30 stimulus checks. And that's the motivation. That's why they bought the property in the first place. And this is also why they're willing to sell the property if they can do better. And that's a big if. And we're going to talk about that a lot today. Number 2, the other motivation is appreciation. Now, my wife works for Azusa Pacific University, and she does a lot of stuff for them. She's not a professor or anything, but we were yesterday talking online like this with her person from the university, and who does all the coordinating for the retirement programs and whatnot. And we were talking about different types of investments and whatnot. You know, we were looking at some of these investments that have gone down because of the stock market has really taken a tank, as you know, during this COVID-19 epidemic thing. Well, guess what happened? I saw some companies that are down 65%, 80% or more. Guess what happens when you have money in a mutual fund or a stock and it goes down? You lose everything, folks. In real estate, it's different. And the reason why it's different is because, you see, not only does property appreciate, but sometimes it has a cycle and it goes down. And that's life. Just as there are different seasons from winter to summer, and then spring, summer, fall, back to winter, and back to spring and summer and fall. It's a cycle. But if the market goes down, or when it goes down, you don't lose your cash flow. You see, in a stock or bond and mutual fund, not that I'm not saying you shouldn't invest and diversify yourself, be diversified in a portfolio. But I am saying is that the beauty of real estate is that you still get a paycheck every single month. You get that stimulus check. And that's the beauty of the property. And it appreciates and pays income. It does both over time. You see that in the bottom, that bottom line, it says over time. This is not a get rich quick scheme. But sometimes when there's so much demand, the price just goes up really fast. And then sometimes, we've seen down markets before. I've been doing this since 1982. So the bottom line is that that's the beauty of owning investment real estate. Now I see that Dave Sparling has a question. What about at this time when tenants are struggling to pay rent? You're right. This is unprecedented. We've never seen that much. Usually that turns into a very ugly market when appreciation stops and obviously depreciation happens. But that's part of the cycle that we were just talking about. I've never seen a market like this. When I began in the 80s, interest rates had 1982, interest rates had just dropped to 18.5%. Have you seen that in your lifetime? I have. I've also seen markets where we've seen surges. And then again in the 90s, I remember distinctively in 1990 through 1995, the market went down. Then it came back again in 96 and it continued to grow slowly but surely. And then around 2000, remember 9/11? It kind of stagnated for a little bit and then it picked up again. And then all the way to the highs of 2006, 5 and 6. But 5 and 6 were artificially stimulated by all those really crappy loans. The stated income where people, they were, you and I both know, they couldn't make a payment, and we saw that. They couldn't afford to make the payments. So why people would even take a loan like that is beyond my thinking. But the bottom line is, and that's a whole other subject, I suppose. But we saw the appreciation drop radically. 10 years ago, we had an incredible foreclosure and short sale market. What happened? People took advantage of that. Investors did, by the way. And what happens? Look at today. The prices are higher today than it was at the top of the 2006 false stimulation market because of the lending. So appreciation continues to happen after bad times. So go back to your question, what about cash flow right now? Right now, you know what kind of questions I'm getting? Can I exchange my property here because I don't like the way California is handling, you just can get out of your rent, you don't have to pay and blah, blah, blah. They're going to other places, folks. And we'll talk about that a little bit more today because that is happening. I'm not saying it's a good thing. I'm just saying the market is what the market is. And my job is to figure it out and to talk to people about it based on what's important to them. But appreciation and cash flow are very important. It's the two motivations. I see we have 2 more questions. Thanks for the answer. You're welcome. Thanks, Dave. Next, tax write-offs. Let me ask you a question. Prior to this COVID thing, were we in the red? How many trillion of dollars of debt did we have as a country? How is that going to be paid for? And now we just levied another over $2 trillion in the stimulus package. And now Congress is talking about another $500 billion. You know how many zeros are after $1 trillion? 11. How are we going to pay for this? especially since revenue isn't coming in right now because people aren't working. And how long will it take to get it started again? That's why they're so anxious to get the economy going again, because how are we going to pay for anything? Through the government or people? And how are business going to start again if people don't have money? So the bottom line is that taxes are going to continue to go up. They just will. I mean, they can cut as much as they want, and I'm all for cutting taxes, don't get me wrong. But it seems like the people who are going to be paying or are paying the most amount of taxes are the people who have the most amount of wealth. And that tends to be the middle to upper middle class and the wealthy, because they have the money. Yes, you can say, well, you know, they have write-offs and blah, 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 but they still pay a lot of money in taxes, whether you agree or disagree. That's just the way it works. And all you have to do is talk to CPAs and they will tell you about it. So the bottom line is depreciation is a very important factor in owning property, both for doing capital improvements to your property and or exchanging and buying up to create additional tax write-offs, because the government wants your money, especially if you earn it and you've worked hard and invested. And that's why investors love property, because it produces income, it goes up in value, and it can be depreciated. How does it work? Well, depreciation is based on what you pay for the property initially. Your CPA will break that into two categories: land value and building value. Building is also known as improvement value. If you look at the purchase price originally, the CPA will say, okay, let's say you bought it for $300,000 once upon a time. Wouldn't that be nice again, huh? Maybe not. You look at he or she will determine the value of the land and the value of the building. Now think about that. That changes from location to location. Because if I'm at the Strand or somewhere near the water or in PV or wherever, the value of the land is going to be higher there than it's going to be in Carson or going east. Does that make sense? So they're going to adjust how they determine the ratios from the land value to the capital improvement or the building value. The CPA knows that you cannot depreciate land. The government won't let you do that. But they will allow you to depreciate the capital improvement or the building of the land. So if it's a residential building, and of course residential is a single family or a condo, a 2 to 4, but what about a 5 and above? Is that a commercial or is that a residential? It's a residential. If it's a 150 or 500 unit apartment building, it's still considered residential. Not to your lender to get a loan, but to the government as far as depreciation is concerned. You'll be able to depreciate the value of the improvement divided by 27.5. How they came up with that number is beyond me. For 27 and a half years, you will take that number and you get to write off that much against your income from the property, which means you reduce income taxes, as you can see on my slide, from the income that the rents generated. And that's really important to an investor because the government's just going to have to require more money. That's just the way it's going to work. So the bottom line is, and the more you make, the more they take. And that's just the fact of life. So the bottom line is depreciation is very important. If it's a commercial building, let's say you have an office building, a storage facility, a gas station, a car wash, whatever, retail, small strip center, whatever, you get to depreciate it not for 27 and a half years, but for 39 years. Same formula, but they just split it and give you smaller amounts of depreciation each year, but they let you take it over a longer period of time. I personally like residential better. And the reason why I do is because you get more depreciation for 27 and a half years, because you need to do something after 27 and a half years for capital improvements to create new depreciation or exchange and buy up. So the bottom line is this is a big, big deal. Now, so what's the benefits? Well, let's go down to the bottom here. You see where it says cash flow appreciation, and tax write-off. The deal is to grow those items. That's what when you connect with an investor, they're interested in that. Some want to maintain, especially when they get older. But for those who, are under the 70s, they want to see growth. They want to see more cash flow, but more importantly, a better rate of return on the equity that's in the building. We'll talk about that in just a minute. They want to see appreciation continue to happen, or how do you appreciate more? And then ultimately, how do you gain more tax write-offs? Because the more you make, the more they take. And it seems like when you get older and you've set all this in motion, well, guess what? You're doing okay, and the government wants more of it. So let's look at, you see where it says property A and B, sort of in the middle of the slide. Property A is in kind of brownish yellow, and property B is in blue. I want to talk about that. Let's say each one of you own 2 properties. Everyone who's watching me right now, you own 2 properties. Property A, property B. Property A belongs to you, property B belongs to you. They're the same street in the same city. So the 2 properties you own are in the same street in the same city. They're the same square footage. They're in the same condition. You bought them in the same year. Everything's the same. Nothing is different except for one thing. Property A has no mortgage on it. It's paid off. It has no debt service whatsoever. Property B has got it's got some debt on it. How much? It doesn't really matter at this point, but it does. Now, let's talk about cash flow rate, and more importantly, rate of return, appreciation, and tax write-offs. Number 1, which property is going to give you, because you own 2 properties, a higher rate of return based on the amount of equity you have invested in the property? Is it property A or property B? The answer is it's going to be split, and I'm going to show you how. Property B will give you a higher rate of return. Why? Because property A has this much equity and property B has this much equity, but they still produce the same amount of rent, because rent is not predicated on how much equity is in the building. It's based on fair market rent. That makes sense? Now, will the cash flow initially be higher on property A? Yeah, because you have no debt and you get to keep it all, minus, of course, expenses, taxes, blah, blah, blah. But the bottom line is, as both properties go up in value, and they will, by the way, appreciation, they're going to appreciate at the same rate. A will not appreciate faster because it has more equity initially. They're both going to go up at the exact same dollar amount because they're on the same street in the same city, with the same square footage and the same condition. So the bottom line is the appreciation will be, even though it's the same, compared to the equity, B is going to do better because I don't have as much equity involved in it, invested in it. I can utilize this to buy other properties in A. A needs to get married and have babies here because it's got too much equity in it to grow. It will grow, but if it diversifies itself and releverages the equity into other properties, they will all grow in income as emerging markets happen again in the future. Appreciation. And you're not putting all your eggs in one basket. We just had Easter this last weekend. You ever heard that? Don't put all your eggs in one basket. I'm telling you, don't put all your equity in one property because you're not diversified. And when markets continue to, well, when they go up, you're not going to go up as fast because you're only appreciating with one asset. And think about this. I've already heard economists start talking about the possibility of hyper appreciation. Inflation. And if it inflates, you're going to fall behind if you have all your equity in one property, as opposed to diversifying and having multiple properties go up in value, multiple doors, multiple units, whether it be commercial or residential. So releveraging is really important to create a better rate of return on the income because you have less invested in it. You could still watch the rents go up and the equity go up. And you have more buildings that will produce income, more appreciation. And then lastly, you have more to write off because you have additional properties. And by the way, the interest that you can write off on a rental per building is not limited to $750,000 loan like the Tax Reform Act brought in a couple years ago. There's no limit of the interest and there's no limit of the property taxes as it is with your personal residence and your second home and your vacation home. So that's a beautiful thing to investors. It really is worth it for them to re-leverage, to grow cash flow appreciation and tax write-offs. Now, have I beaten that to death yet? I'm doing that for a reason. It's so we can see that when we meet with these people, or you meet with them. Remember, 80% of what you do is meeting with people, is showing up. You've got to be able to talk about these things. And trust me, this is why they bought their properties. And this is why they're probably going to expand. Now, some people want to get out of property at the time. You know, I'm not naive enough or stupid enough. You know, I understand that. But I'm talking about the majority of people, folks. And this, even in bad times, this too shall pass. And we're going to go right back to this again. And that's just the way it works. Okay, so let's say I do sell the property because I want to re-leverage. You know, I could refinance it, right? And take cash out and buy. Or I can sell. But, you know, different people treat it a different way. I find that the majority of the people do tend to want to sell. The question is, will I have to pay taxes when I sell the property? The answer is, yeah. Why? Because the government wants your money. And the more you make, the more they take. So here's the deal. Do they charge me a tax based on equity in the building? The answer is, why? Because I could always refinance the equity out and then sell and say I have no equity. And the government wouldn't charge me tax. So guess what they don't do? They don't base taxation based on equity. They base it on something called right on your screen, the upper left-hand side, a capital gain. How do you determine what a capital gains tax is? And how do you kind of measure it? Well, the first thing is, and this is really, really important, I want you to look down at the screen where it says at the bottom, only your client's CPA or tax attorney should attempt this, not you, not me. Why? Unless you have a license to do this, you're not allowed to do that. It's illegal. But the bottom line is that it's okay for you to do this in your head to kind of get a feel for it, or at least understand where the tax people are coming from to determine what a capital gain looks like. So I kind of have a simplified little deal here. It's a very complicated formula, but I want to show you in a very simplified manner what it looks like, okay? Number one, you take the sales price of the property. In this example I have up on the screen, it's $1 million. Number two, I bought it for $300,000. That was my purchase price. So the government ultimately subtracts what I bought it for from what I sold it for. And the difference is my capital gain, number three, which in this case is $700,000. Now that's overly simplified, way overly simplified, and it's not going to be this number. But I'm going to show you why I've kind of, what the theory is behind it and what exactly the government is looking for. All right. The purchase price is $300,000 under number two, but the government or your CPA will adjust not the purchase price, but what they call is the adjusted tax basis based on a few things. And here are some of those things. Number one, your purchase price. Number two, anytime you add a capital improvement to the property. Now, I didn't say repair. I didn't say paint and carpet, fixing the garbage disposal. I'm talking about an actual improvement. What's an improvement? Well, that's when I add on, or that's when I remodel, or that's when I put in double pane windows or solar this, that, or the other thing, or upgrade a roof to a higher quality roof. When I do something to create more life to the building, that's a capital improvement. And your CPA knows that you can add to your basis when you add to a capital improvement to your building. So if I decide to put in $150,000 in upgrades, well, guess what? My basis then changes from $300,000 to $450,000. Now let's subtract. $1 million minus $450 is going to equal what? $550. Well, my gain just went down by $150,000 because I put money into my property, which means I would pay less in taxes when I sell the property, or less in capital gains. Now, what's really important too is that there's a second benefit of doing capital improvements to your building. You know what that is? Anytime you do capital improvements, not only do you raise the basis of the property, but you create a new layer of depreciation. Remember we just talked about that? Paying less in income taxes on the rent you collect. Well, what happens is, I want you to visualize, I don't know what your favorite kind of cake is. Let's say it's chocolate. And let's say you like multiple layer chocolate cake. Well, I want you to look at depreciation as a layer. But if you do a capital improvement, then it creates another layer of cake. And then another capital improvement goes as another layer of cake. And you're running 3 different layers of cakes in one slice of cake. In other words, you create additional levels of depreciation every single, for 27 and a half years, every time you do a capital improvement. And that is a real benefit to an investor, because not only do they get to write it off, they also raise their basis. So they get a double positive out of it. Next, depreciation itself. Depreciation itself lowers the basis because the government feels that you're getting a tax benefit of being able to write it off. So they lower the basis, which is bad. It is what it is. Last, closing costs. I have to factor in, I have to hire you to sell the property. I have to hire an escrow officer. I have to get a title company involved. I have to pay for transfer taxes and recording fees and other one-time costs, fees to sell. So even an exchange combinator if I'm doing a 1031 exchange. So the bottom line is that will all factor into the increase and the decrease of the basis. So at the end of the day, when I sell the property and close escrow, the CPA is going to calculate whatever the adjusted basis is, subtract it from my sales price, and the difference is going to be called my capital gain. And that's what the government's going to charge me taxes on. Make sense? All right. So the next question is, how much? Because the bottom line is, how much is it going to cost? Anybody ever ask you that question? Do you ever ask that question? Well, every taxpayer is going to ask that question. And every time they call me up and they say, well, Phil, I want you to set up an exchange, but what if I don't? What is it going to cost me in taxes? Everyone wants to know. So let me show you kind of a fee schedule for capital gains taxes. If you decide to sell a property, this is how it works. A rental. Number 1, whatever that gain is, and we just looked at it, let's just say it's 700 just to make life simple, because these are the numbers we have on our screen. That means you would pay 20% of the $700,000 to the IRS. Now let me just emphasize it. It's up to 20%. These are as high as, okay? Not everybody will be in the highest tax bracket, but the more you own, the more they will. So the bottom line is up to 20% to the IRS. In fact, if you take the word the IRS and put those 2 words together, what does that spell? It spells theirs. Number 2, anybody ever hear of the Medicare tax, the healthcare tax, the Affordable Healthcare Program, Obamacare? It's all the same thing. Well, guess what? That went into effect when they passed it. So now when you sell your rental properties, if you're single and own it as a single entity, anything above $200,000 a gain, you have to pay an additional 3.8% into the healthcare program. If you're married filing a joint return, it's above $250,000 that you pay this additional 3.8%. So they look at the gain above $200,000, you pay an additional 3.8% to the healthcare program. If you're married filing a joint return over $250,000, they give you, that's what you pay your 3.8% on. Number 3, welcome to the state of California. We're number one, but not in a very nice category. We're the number one tax state in the United States of America. Currently, the tax rate is between 9.3 to 13.3%. The average person is going to be around the 9.3, but the investor who has a few properties is going to be at the 13%. So that's what they pay, those number one, number two, number three, and then they pay number four. Number four is called the recapture of depreciation tax. Remember how I said initially that we create depreciation by coming up with the, if it's residential, 27 and a half years, and I get to write it off each year for 27 and a half years? Well, the government says that is called allowable depreciation, and allowable means you can do it. If you're allowed to go out without a mask, that would be, it's okay for you not to wear a mask, right? But you're allowed to take the depreciation. As long as you qualify for it, you're allowed to. The government says that whether you take the depreciation or not, I want you to get that, whether you take it or not, you have to pay a 25% tax when you sell the property on the allowable depreciation, whether you took it or not. And that's the way the government does it, folks. So my recommendation is, if you're not taking the depreciation, you should probably start because you're going to pay tax on it. It's pretty heavy duty. Now, can I just back off of investment property for just a minute? I want to talk about your personal residence or your second home or your vacation home. Let's go back to the capital gain. Let's say this is not your rental, this is your personal residence. You bought it for $3 million, the adjusted tax basis is $3 million. You sell it for $1 million, you have a $700,000 gain. If this is my principal residence, which I happen to be talking to you out of my office from my personal residence this morning, and since I've owned this property, my wife and I have owned it for 31 and a half years now. And we've always owned it, the two of us, we're both on title. Technically, it's our trust that is on title. And we've always lived here. The government says that when we sell this home, I'll be able to deduct off the gain $500,000, up to $500,000. Why? Because we've owned it, the two of us have owned it. We've lived in it for at least 2 years. Obviously, it's been 31 years. So the bottom line is that the government will subtract or exclude $500,000 because I'm married filing a joint return. That's called the one, and you should remember this, it's called the 121 principal residence exclusion. They exclude gain. In this case, they'll take $500,000 off, which means I still have $200,000 of extra gain. I would have to pay these taxes right here, the 20%, the 3.8, and the 13.3. I would not pay number 4, the recapture depreciation, because I don't depreciate my home. I just depreciate my rental properties. Does that make sense? So I would pay 1, 2, and 3 on the $200,000. Now let's say I was single, or you have a married couple, but not both of them are on title, only one of them are. Because to qualify for the 121, you have to both own the property, and you both have to live in it for 2 years or cumulatively 2 of the last 5. Then if that's the case, or you're single, you only get $250,000 exclusion of gain. So that $700,000 has now been reduced to $450,000. Now on that $450,000, guess what you get to pay? Number 1, number 2, and number 3. And that's not for you to disseminate to your clients. Let's to give them a feel or an idea to go talk to their CPA that that's how it works. Make sense? Any questions about that? Oh, I see that there's already a question. All right, paying the 3.8 when married, we pay over 250, meaning the difference between 250K and your capital gains. Well, the 250 covers all those taxes. I hope this is going to answer your question. And if it doesn't, please call me back afterwards. I'd be delighted to talk with you. The 250 is going to be all encompassing of the 20%, the 3.8, the 13.3. And that's what we'll do. Anything above that, you will pay these numbers on. So I think that's what your question was. And if it's not, I apologize because I don't understand it. So you call me back and we'll discuss it and I'll give you a straight answer. All right. or I'll tell you to call your CPA. Next question. Oops, this happens sometimes. So what is a 1031 exchange? Let's go back to rental property. Oh, I forgot to say one more thing. On these numbers, 1, 2, and 3, you don't get the 121 exclusion on your second home, your vacation home. You don't get any reduction of gain, even in a 1031 exchange on a second home or your vacation home. So you would have to pay all of 1, 2, and 3 on the entire gain of your second home or vacation home, unless you convert it into a rental. And to do that, you call your CPA, they set up your property on a depreciation schedule, and you've got to claim the rent. Very important. All right. So what is a 1031 exchange? You notice under where it says here on the screen where it says 1031 tax, and then I underline deferred. I want you to think about that word for a second, deferred. I want you to look down again on the screen, a deferral of capital gains. Number 3, so to defer all the profits and gains for the purpose of, it's not tax-free, it's tax deferred, which means I am allowed to sell the property and to take my low basis with me and all the gain to the next property, as long as I buy for roughly equal or more than what I sold for, and reinvest all the cash. But it defers the tax. It doesn't eliminate it. A lot of people think it eliminates it. Sorry, it's just a deferral. But what's the purpose of the exchange? It allows me to sell and replace or buy, purchase. Why? And please look at the blue writing on the bottom. To acquire better income, cash flowing, rate of return, appreciation, depreciation. It's not just for not paying taxes. It's for growing my portfolio. It's for making more money. And that's the purpose of the 1031 exchange, to defer the tax to get to that point. Will I eventually pay the taxes? Yes, if you cash out. And if you cash out without exchanging again, you're going to go back to whatever that adjusted basis is that came with you from property 1 to property 2 to property 3, subtracted from the sales price, which is going to be at this point 5 million, 7 million, and the difference is going to be your gain, and you're going to cry. And you're going to need therapy because it's going to cost you dearly. Or you don't. If you sell, you exchange into other properties that are going to be better for you and your lifestyle to take care of you as you get older. And guess what's going to happen? You would be wise to put it in a trust, or if it's an LLC, where each property is under its own LLC, your trust they'll be the shareholder of the LLC, not you. And when you pass, it goes to your surviving spouse or to your heirs at a stepped up basis. See that in blue? A stepped up basis. You know what that means? That means as long as I'm alive, that $300,000, adjusted basis thing goes with me from property to property to property to property. If I cash out, the sales price minus the adjusted basis is what I have to pay. But if I put it in the trust, and I continue to enjoy the benefits of the equity and the income of the building, and then I pass, it goes to my surviving spouse or my heirs, not at the $300,000 basis, but at the $7 million fair market value at the date of my death. And that becomes the new stepped up basis for my surviving spouse or my other heirs. That is incredible. Just by itself, that is incredible. And that's why our industry echoes, swap till you drop. In other words, keep exchanging, keep growing your income, keep buying better properties, and enjoy the benefits of them. And when you do finally pass, give them to your heirs. And what happens? They get it at a stepped up basis, to turn around and sell it and pay 0 in capital gains taxes. unless they hang on to it in trust for a while, and then they'll rebuild another gain over time. Does that make sense? This is really important. I cannot emphasize this, the last sentence on the bottom. You must consult or have your clients consult a good tax professional or estate planning attorney for more details. It's not fair that you and I don't have licenses. Either we're not a member of the bar, and we're not a member, we're not an enrolled agent, we're not a CPA. We can't be giving this kind of information, but we can kind of allude to it and tell them to go talk to these people. And really, honestly, on your team, you need to have people who work with you on your team, like a CPA, like an estate planning attorney. They're not on your payroll, but they're people that you know who are very good at what they do in this area. And you can just simply say, if you don't have someone, I've got someone who really specializes in this, they're on my team, they'll spend some time with you. And I'm telling you folks, that is the way to connect people together, because this is a people business. Make sense? So how do I set up a 1031 exchange? Wow, times just keep flying. We're almost halfway through. We've got so much to talk about. How do I set up it? By the way, if you have a question, again, feel free to just let me know, and I'm delighted to type it in. If I understand the question, I'll do my best to explain it. So how do I set up a 1031 exchange? The answer is, first thing you do is when you take a listing, you've got to ask the seller, why are you selling the property? What do you plan on doing with the money? What are you going to do with the proceeds? Are you going to reinvest it? Are you going to walk away and pay taxes? Have you talked to your CPA about it? And the reason why you want to ask these questions is, number one, they may have a big gain and they don't even know it. And they're going to get killed. And then they're going to call me and say, Phil, I need to set up an exchange. And I'll say, sure, give me the name of the escrow officer. I'll call them up and get it set up. And they'll tell me that escrow closed yesterday, or a week ago, or a month ago. And I have to hang up the phone, folks. I can't do it because the government won't let you do it. Once you close your sale, you have scrambled the eggs. You can't put it back to the way it was. It becomes taxable. You cannot backdate it. That's why you really need to ask those questions. Why are you selling the property? What do you plan on doing with the funds? The second reason is because you want to have not only the listing on this sale, but you want to help your client on an acquisition to buy. Last time I checked, 2 commissions are better than 1, right? So that's a beautiful thing about working with people who are doing exchanges. The chances of you getting multiple commissions begins to grow. So how do you do this? First of all, when you take your listing, you need to put in your agent's remarks that the seller is going to do an exchange, the buyer is going to cooperate. If it makes you feel better, no cost to the buyer. But you need to have your zip form involved. In fact, if you look in the middle under where it's the kind of that light grayish blue, there's two zip forms that you have in your CAR website. Number one is called the seller's intent to exchange. You're not going to, if you type in 1031 exchange, it's not going to show up. You have to type in seller's intent to exchange. Number two, when you go to buy a replacement property, you need to put the zip form in the contract as well. Buyer's intent to exchange. It's important to put that in. Why? Because you see, a facilitator must set up the exchange. And for a facilitator, a company like ours, to do that, you have to invite us into the contract. If we're not invited into the contract, we can't come. My youngest daughter is getting married. It was supposed to be June 20th, but with all this COVID thing, that's gone. So we're shooting for Labor Day weekend now. So guess what? The venue we chose only takes 200 people. So we have only a limited amount of space to have people there. In other words, even though we have friends that are on our B list, sounds terrible, doesn't it? They can't come unless we can clear some room and get them an invitation. No invite, no attending. The same is true with the accommodator. If we're not invited into the contract through the ZIF form or language that you put into your RPA, we can't get into the contract. So if you don't put that in, escrow will do it. But they're going to have to do what? An amendment to the contract, which means they're going to have to go back to both parties, you and the buyer. Or when you go to buy, you and the seller. And if the two of you are not getting along, or somebody wants to use this as leverage against the other, it could cost you. So it's always better to get this information up front so the accommodator can be a part of this without somebody trying to hold it against them or using it as a bargaining chip. So set up the exchange with the facilitator as quickly as possible, but for sure before escrow closes. And please don't wait till the last minute. It makes your escrow officer crazy. And don't forget, your seller has to fill out the 593 form for the state of California. And item number 10 is going to ask them a question. Is this part of a 1031 exchange? And they need to be able to answer that. So that's really, really important. Next. What kinds of properties are eligible for an exchange? Not every property is eligible, folks. It only could be investment property. And here's the definition of investment property. It's either held for rent, for income. Number two, it's held for business use. Either you're renting it out to somebody who has a business in it, or your business is in it. And you operate your business out of that property. That is also eligible for an exchange. Number three, vacant land. If you're buying and holding it, that it will go up in value because you think it will, that is allowable under a 1031 exchange. I just want to caution you about something. And this is becoming more of an issue. And in fact, when I was there, back in January, I think it was, we were talking to those young professional groups and stuff there at your board. I was speaking with a CPA there, and I posed the question to him, and he agreed. If you're renting to a relative, like a brother, a sister, an uncle, an aunt, a cousin, or whatever, and the bottom line is you're not charging them fair market rent. Oh, by the way, that includes a dependent parent or children. And they're giving you minimal amount of rent. That's not a rental property. According to the government, it's a second home or vacation home. Not a vacation home, but a second home. And second homes don't qualify for a 1031 exchange. So if you rent to a relative or somebody who's related to you, make sure you're getting 85% of fair market rent. Or if the government figures it out, they can go back and disallow your exchange. It's very, very important. And CPAs are becoming more and more concerned about this. So if we know what is allowable, next question is, what is not allowable? Which properties are not allowable? Well, first of all, a business is not allowable. So if you're selling a property with a business on it, you can exchange the property because you're doing your business in the property, but the business itself is not exchangeable anymore. So only the property. Number two, a primary residence. Remember, you only get to use the 121 principal residence exclusion up to $500, up to $250,000 reduction of gain that we just talked about a few minutes ago. But what if I own a duplex or a fourplex? Multiple unit property, and I live in one unit and I rent out the rest. Well, then the client would need to go back to their CPA, tell us how they've been writing it off and what the percentage is of the sale that is personal residence versus investment property. And the investment property, we can set up a 1031 exchange, and that is eligible. But not the personal residence. They can take the 121 principal residence exclusion on the gain off just that portion, that fraction of the building that is their primary residence, as long as they qualify for the 121. Your second home, again, your vacation home, they are not exchangeable. Lastly, flipping or developing is a very questionable gray area. Instead of putting it in purple, I should have put it in gray, right? It depends on the CPA. And we reserve the option for the CPA to exercise their judgment so they can make a decision whether they think their client will qualify for the exchange or not. Generally speaking, it's not, but there are other opportunities where they might be able to, according to their CPA, their tax counsel. So let's you and I not play that role. Let's definitely not give them tax advice and let their CPA do that, because you and I are going to be held liable for it and don't want to go there. Now, the government says it has to be a like-kind exchange. What does that mean, like-kind? Let's say I'm selling a rental condo and I want to buy vacant commercial land. Is that like-kind an income-producing residential condominium or townhouse to vacant commercial land that generates no income? Is that like-kind? The answer is yes. Why? Because the definition of like-kind is the sale of what? Real property, not personal property, but real property that you hold for investment. And your vacant land that you're acquiring is still considered as real property that you're holding for investment. You say, well, I'm not making any income. Plus it's commercial and I'm selling residential. That has nothing to do with it. As long as it's the sale of investment property and it's the purchase of investment property, you can change the types of properties you go into. Commercial to residential, the other way around, vacant to approved, the other way around. And the next question is where? I can buy anywhere in the country, anywhere in the USA. I'm not limited to Los Angeles County. I'm not limited to California. I can buy anywhere in the country. You want to buy in Hawaii? You want to buy in Texas? You want to buy in Idaho? You want to buy in Florida? You want to buy in Montana, in New York? It doesn't matter. As long as it is investment real estate for investment real estate anywhere in the country, it qualifies as a like-kind property, therefore allowable under the federal government for the purpose of a 1031 tax deferred exchange. How do you like those apples, huh? Now there's 5 basic ways of doing this, and I'd like to go through that. Boy, I don't know what I'd do without this water, huh? Number 1, a simultaneous closing used to be popular, but it really isn't that much anymore mainly because of TRID and CFPB, but mostly because of a lawsuit. Somebody actually sued the IRS and the United States Treasury. You know the difference between the two? Well, the IRS is who you submit your tax return to, right? But when you owe them money, you don't pay the IRS. You make it payable to their boss, which is the US Treasury Department. Same is true if you get a stimulus check back or any kind of refund from the government. It doesn't come from the IRS, it comes from the United States Treasury Department. So the United States Treasury Department is the boss. The IRS is the mafia hand of the US Treasury. Whoops, this is recorded. Don't hold this against me. So what happened is when Mr. Starker took the government to court, he litigated for a couple of decades and won. And now as a result of this court victory by Starker against the US government, you no longer have to exchange simultaneously. You can do it now in other manners. For example, a delayed manner. A delayed manner is that you can close the sale first and then close the purchase up to 180 days later. And that's what we have the extension on that we just spoke on. Now I see somebody has a question. So let's see, Jesse, what do you think to change to a DST? I think a DST is a legitimate type of replacement property. If it's right for you, then it's like-kind. It is like-kind whether it's right for you or not. But if it's the right property, you can buy a DST. If you're wondering what a DST is a Delaware statutory trust. Now, if you probably have noticed in the last couple of years, you've had people going around your offices, going to the boards, talking about another kind of DST. It's called a deferred sales trust. Those are illegal. The IRS will tell you that, and the Franchise Tax Board just issued another memo copying the IRS on that, saying the IRS doesn't agree with them, and neither do we. They don't, whatever those people tell you, do not believe them. The government keeps telling you it doesn't qualify, and you will be charged capital gains taxes on those DSTs that are called deferred sales trust. The question that was just asked is about a DST, which is a Delaware, like the state, statutory trust. That's when you, instead of you buying a Walgreens, you can buy a part of it, and or a part of other buildings, multiple acquisitions to total to equal or greater what you sold for. And those DSTs are allowable in a 1031 tax deferred exchange. All right, hope that answers your question. A delayed exchange says you have 180 days beginning the closing of the sale to close whatever you're going to buy. 180 days means tomorrow's day one, if I close today. And it's not 6 months, it's close, but it's not, it's less. Okay, and the government now says, like I'll just reiterate, under the COVID-19 extension, if your closing date of 180 days lands between April 1st and July 14th, your new closing date is July 15th. Number two, you also have the first 45 days of the 180 days to name the address of the property you're going to buy, whether it's a DST, whether it's an individual property, or you're going to buy multiple properties. They all have to be named and identified before the end of the first 45 days of that 180-day closing period. Okay, that means you don't have a lot of time. That means, in my opinion, you really need to know what you're going to buy before you close the sale. It also means that if you utilize that zip form that we were talking about earlier, there's language in the zip form that allows you to put in contingencies that says that if you're not in escrow on an acquisition, you can extend it an extra 30 days or an extra 60 days or whatever. And that's what you're going to negotiate out with your buyer. Because the key to the exchange is finding those replacement properties and not panicking that you can't find something and settling for something that's less desirable. Because the purpose of the exchange is to grow cash flow, appreciation, tax write-off, diversification, better properties, making more money. So why would you want to just panic because of a low inventory? So that's the beauty of that zip form. But you only have 45 days as a deadline from the time the sale closes to identify. Remember, the 45th day has been extended if your 45th day is between April 1st to July 14th. It's been extended to July 15th. If your 45th day was in March, you lose. You don't get an extension. If your 45 days is going to be on July 15th, there's no extension, or beyond, there's no extension. Those are the only dates they'll give you the extensions on. So the bottom line is that's the COVID-19 extension, and these are the identification and closing periods. Now, the next question is, how many properties will the government allow me to identify? Well, it depends which rule you choose. The first choice is called the 3-property rule. Most people will utilize this. The 3-property rule says you're going to identify up to 3 properties. You see where it says, how many properties may I identify on the screen? And it says 3-property rule, ID up to 3 properties, no value limit. That means if you sold for $1 million and you want to identify $100 million properties, you can do that. There's no limit to value. There's just a limit to having 3 addresses or 3 tax parcel numbers or 3 APNs on the identification sheet. That's it. And if you're going to go with an address and there are unit numbers involved, you have to be specific. And it has to be what the government says is a non-ambiguous description, which means you have to disclose what the unit is. Number 2, if you need to buy more than 3 properties because you're going to go into other type of like-kind properties like a farmland, or an avocado grove, or lots of little, I talked to somebody yesterday, we're going to be doing some exchanges in Alabama. Wherever it happens to be, where the values might be a lot lower, you may need more than 3 properties to buy for equal or greater. That's when you would use the 200% rule. The 200% rule says you can now identify 4 properties or more, but with a value limit. Whereas the 3-property rule, no value limit, just 3 properties. But with the 200% rule, you identify not only the address or APN or legal description, but you also have to identify the fair market value, each identification. So let's say you do 4, 5, 6, 7, 8, 9, 10 properties, whatever. you have to identify all the values for each property. Then you have to total all the values together. The total value of all the properties under the 200% rule cannot exceed more than 200% of the sales price of what you sold. In other words, if I sold for $1 million, I can't identify more than $2 million worth of property. Just because I'm adding more properties, it doesn't give you more value other than twice as much of what you sold for. You stay with the 3 property rule, there's no value limit. So if you get confused, call me back. I'll be happy to discuss it or put something in writing to you that looks like this, or if you're taking a picture of your screen right now. But the bottom line is that most people here in the big city are going to go with the 3 property rule. Next. Okay, there we go. There's something called a reverse exchange, and there's a lot of misunderstanding about this. I'd like to clarify it. A reverse exchange, number 1, means I have to close my purchase first and then close my sale afterwards. Now, most people would agree that's what a reverse exchange is. But the implementation of an acquisition is different in some people's eyes. Some are wrong and some are right. So let me give you the government's position. A reverse exchange is that you're going to close a purchase, but not by yourself. The accommodator has to be involved in that escrow. And we have to set up, if you look down at the bottom of your screen in red, you'll say an EAT. It's called a holding corporation or an exchange accommodation title holder. That's what EAT stands for. We have to set up a holding corporation. It's required. And we're going to take title to the one you're selling the day before you close your purchase, because you have to relinquish it. You can't take title to a new property and still have title to your old property you're selling. The government won't let you do that. Because once you close your sale, you're going to say, I'm going to exchange into the property you already own, that you already bought and closed on beforehand. And the government says, I don't think so. So what happens is we either take title to the property you're selling the day before you close your purchase in this corporation, or we actually take title to the new property and hold it for you until you close your sale. Now, is there a deadline on when the sale has to close? And the answer is, you betcha. It is 180 days. And the 180 days begins the day we take title to the relinquished property, which is the day before you close your purchase, or the day we take title to your new purchase. And if you go in all cash, we will probably take title to the property you're buying. If you have a lender, we will probably have to take title to the property you're selling the day before you close your purchase, because the new lender won't let us take title to it because they're lending the money to you, not us. This is what the government requires in a reverse exchange. We cannot hold property more than 180 days. You have to close the sale within 180 days. So remember, I get a lot of calls where people say, Phil, I need you to set up a reverse exchange. I said, sure, we can do that. The problem is they have title to the replacement property and they never got us involved in the escrow. Sorry, it's nothing but a purchase. You can't exchange into it from another sale that you're selling. It doesn't work that way. So be careful, be careful, be careful. You know what the purpose of a reverse exchange is? You find the pearl of great price. You find a drop-dead property. I had a guy called me up, he's buying a property in Arizona yesterday. And he may have to close that first before his sale. That property is worth it for him to close first and then his sale, which means he's going to have to advance cash for the acquisition because he hasn't had the benefit of closing a sale, which means there's no money. So he'll either go in all cash, or he'll have in some cash, or he'll bring in a hard money lender, or he'll bring in a second, or a line of credit, or a bridge loan, or a swing loan, or some other type of financing from a friend or a relative. Or the seller will carry back for him until the sale closes. But you have to have financing and or all cash to pull off a reverse exchange. Why do you want to do it? Because it's the pearl of great price, or you're getting an unbelievable deal on this property, or it's a great property with low maintenance on it, and it's in a great location, and it's the right property for your client. And that's what the reverse exchange is about. Does it cost more? Oh, you bet it does. It's like 9 times more in price than a delayed exchange. Is it worth it to spend $7,000 more for a reverse exchange? You tell me. Would you pay $7,000 more for the right property, considering how many hundreds of thousands and millions of dollars properties cost? Is it worth it? I can't answer that. Only your client can. But the bottom line is, most investors will do it for the right property. Would I rather do a delayed exchange and pay a lot less money? Yeah, I would. But if this is the only way I can get it and it's going to make me a lot of money, it may be worth it. There's something called a build-to-suit exchange, and I want to just comment about this. I don't want to get into the depth of it because I think Nikki is going to have me come back and we're going to do an advanced class where we're going to spend a little more time on the reverse exchange, and I'm definitely going to spend more time on this build-to-suit exchange. Here's the question that people ask, and I get a lot of it these days. It's like it's in the water or it's in the air somewhere. I don't know why I'm getting this question so much. Can I do a 1031 exchange and hold back some cash that after I acquire the new property, I can do some fixing up to it or some capital improvements to the property as soon as I close the purchase? So now I've got the money from the sale, I bought the property, and I left some money to be held back. Now I want to put it into the fixing of the property. Can I do that? The answer is yes, but you'll pay taxes on that money. Why? Because the government says all the cash from the sale has to go into the acquisition, not into the fixing of the property after you buy it. It's too late. It becomes taxable by that point because all the money has to go into the acquisition. So you say, well, then how can I do a construction or build or do improvements to property I'm doing with the funds that came out of the sale? Then you would have to do this thing, number 4, called a build-to-suit exchange. It allows for a construction while we set up a holding corporation. We're back to that again, where we're holding title to the new property because we're able to buy the new property with the funds that came from your sale, and the remaining balance of funds will go into the property's building or improvements until you take title to the property. And you have to take title within 180 days from the time your sale closes. So that means you got to close your purchase real quick. You have to have your contractors and your permits ready. The building commences as soon as we take title to it. You have to identify everything you're going to do in terms of not only the address of that property you're going to take within the 180 days, but all the improvements that you're going to build into it. And the fee goes up another $8,000 or $9,000. So the bottom line is they're very expensive to do. You know, that's questionable whether it'll work for you or not. If you're going to just be doing, you know, $15,000 or $20,000 worth of fixing, you may be better off just getting a swing loan or get a second on your new property, and then put that into the construction or the improvement of the property or the repair of the property, and then it's a write-off. Or keep some cash back, pay taxes on the cash, and then put that money into it. But the bottom line is the build-to-suit exchange is really for that purpose of not paying any taxes at all, but it has to be a substantial type of building. There's also something called a hybrid exchange. We'll talk more about that at our next time that we get together with our advanced class. It allows combining delays exchanges and a reverse exchange under one umbrella. So example, let's say I'm selling 2 properties. Whatever property closes first starts my 180 days and my 45 days to identify, right? The second property has to close that I'm selling, and then the purchase. So 2 sales are going into one, and the timing is all going to be based on the first closing. Now, second property I can't close, but I've got to close the purchase. So now the government will let me do a delayed exchange on property number 1 into the purchase. But at the same time, they will now allow us to set up a reverse exchange on a part of the same purchase, so the second sale can close up to 180 days after the purchase closes. So all it does is combine 1 and 2 under the same umbrella, the delayed exchange and the reverse exchange, and we could talk more about that at another time. That is an awesome thing for people who are selling multiple properties or buying multiple properties and need help with timing. And the hybrid exchange comes through. It's not cheap, but it fixes the problem. These next few slides are very, very, very important. And I want you to please take, if you want to take pictures or whatever, but I need you to make sure that you get this. Because this is, you cannot believe how many errors and mistakes are made that will cost tax dollars because people thought they knew what it was, but they were wrong. And I'm here to bring you, the information, real news, right? In terms of the accuracy of what the federal government has given us. Number one, when you sell a property, all the cash from the sale has to go into the purchase. All of it. The only thing that can be taken out without paying taxes on are 2 things. Your non-recurring closing costs, and I've got some slides we're going to go over this with. And number 2, the loan, because the loan has to be paid off, right? The title company will not insure the sale transaction unless they do the payoff of existing debt. Plus you have to pay non-recurring closing costs. So the bottom line is, what a requirement is from the IRS is that all the cash from the sale has to go through the accommodator, but be reinvested into the new one or multiple purchases. Whether you're buying a DST, whether you're buying a one property or just multiple, rentals or investment properties, business use properties, like-kind properties, all the cash has to be distributed out, not into a later construction of the property, but into, unless you do a build-to-suit exchange, but into the acquisition. You're not supposed to have any cash left over when the exchange is over. If it is, you pay taxes on it. Number 2, you have to reborrow. That's really important. Any mortgage that was paid off on the sale of the relinquished property. In other words, you cannot have any debt relief from the sale to the purchase. If you pay off $400,000 of debt, you have to reborrow $400,000 of debt on an acquisition. That includes a first, a second, a HELOC, a line of credit, whatever. Any debt that's paid off has to be reborrowed onto the acquisition. That's what equal or greater means. And whatever's not accomplished, you pay taxes on the difference. It doesn't destroy your exchange if you keep some cash. It doesn't destroy your exchange if you don't replace 100% of the debt. It means you pay taxes on the difference. Now let's get into a little bit more detail on this. Let me show you an example. Your sales price is $1 million. Your non-recurring closing cost is $70,000. Now that's what, 7%, kind of, sort of. $1 million minus 70 equals 930. So now your $1 million is trimmed down to 930. Now, if you have no debt, go down to number 6. Your new minimum purchase price has to be 930. Why? Because the government allows for non-recurring closing costs to come out of the proceeds of your sale. That's great. And we're going to get into more detail as to what that means. So all the non-recurring closing costs is allowable to be paid off. What is that? Your commissions, the escrow company, the title company, transfer taxes, recording fees, my fees. That's a non-recurring cost to sell. Anything that is a one-time cost to sell. What is not considered a one-time cost to sell? Property taxes, insurance, HOA fees. But if I'm selling a condo, don't I have to pay for articles of incorporation and copies of fidelity bonds and the CC&Rs you provided? And the HOA company is going to really stick it to me for doing that. I have to pay an additional fee for that. Well, those items are considered a non-recurring cost to sell because the buyer is requesting that I provide a copy of the CC&Rs and the articles of incorporation. Anyway, the bottom line is that I can do that as non-recurring, but not make my normal payments to the HOA. That is recurring, as property taxes are, insurance is. All right. So that's what can come out of the proceeds of the non-recurring closing cost sale. So $1 million minus 70 leaves me 930. Now let's say I have $400,000 of debt that has to be paid off. That includes the first, the second, line of credit, HELOC, whatever. That's debt against the property. Some people say, well, but that isn't what I originally borrowed. I added some additional debt on the property later on. So as long as it hasn't been in the last 6 months to a year, it can be paid off. So whatever the total payoff is at the close of the sale, and let's say it's $400,000, you take the balance of cash of $930, you subtract the $400,000 of payoff, that leaves at the close of escrow $530,000. That money will be wired to the accommodator. Not really to the accommodator, but it should go to the bank, directly to a bank account that's going to be set up for the exchange. Now, the new minimum purchase price is $930. What does that mean? That means I have to, like we said in the last slide, I have to replace the cash of $530 that the accommodator is holding into the acquisition of the new property. And it also includes my reborrowing number 4. I have to replace $400,000 of loans or more. So what does that look like? I'll show you. This is how you replace mortgage debt. Number 1, you get a new mortgage for $400 or more. Some people say, I don't want to. I just want to exchange the cash. Well, fine. If that's the way you feel, then pay taxes on the $400,000 of debt. Because the bottom line is, that's what the government's requiring for you to defer your tax, to be able to reborrow the same amount of debt or greater on the acquisition. They'll let you go up, but they won't let you go down. Well, they will, but you have to pay taxes on the difference. Or the second option is bring in new cash. New cash means you have stocks, you have bonds, you have mutual funds, you have cash in the bank. You withdraw that and you put that new cash into the purchase of your new escrow for your replacement property. The government says that anytime you add new cash to your acquisition, that's like reducing the amount of loan. It's like a payoff. That's the way they look at it. So if you want to bring in $100,000 of new cash, now you're only required to reborrow $300,000 because you offset the 4 with 100 of new cash. Make sense? If you don't want to have any loan, you bring in $400,000 of new cash. You want to bring in $300,000 of new cash, now you're only required to borrow $100,000. But you got to come back up to $400,000 because that's what was paid off on the sale of the relinquished property. Next, seller carryback loans qualify. So for example, if my seller of my replacement property is willing to carry back the $400,000, that would be allowable. Even though it's a personal note, it's a private note, it qualifies. It doesn't have to be an institutional note, folks. It just has to be debt. Next, assuming the seller's loan is allowable, or a combination of any of these are allowable as long as you replace that debt of $400 with another cumulative loan or loans of $400 or greater. Does that make sense? Now let's talk about the selling expenses. There's recurring versus non-recurring. And we just spoke a few minutes ago about like the HOA, you can't make back payments and stuff, normal, ongoing, recurring costs of the HOA, but you can pay for articles of incorporations, copies of the CC&Rs, a fidelity bond, that kind of a thing, those kind of things. So that's the difference between recurring and non-recurring. So let's talk about this real quick, because this is really important. We already said commissions, escrow, title insurance, transfer taxes, recording fees, my fees. We went over the basics. There are other ones as well. So how do we distinguish between the two? Where recurring costs are not allowed to come out of the cash. You will pay taxes on that if you pay under your closing fees recurring closing costs. Only non-recurring closing costs are allowable. So let's say you take my listing and I say to you, take my listing, sell the property, what do you think it'll sell for? And you'll say, well, Phil, this property will sell for $2 million. But you've got some issues on this property. We see some dry rot, some electrical problems, we see some plumbing issues, maintenance, paint, whatever. You know, you can get a lot more for your property if we just fix it up. So the bottom line is, I agree to do that. I fix it up for the purpose of selling the property, all right? So what happens is, I just saw somebody had a question, but I'll get to it in just a second. So we say, okay, we'll go ahead and do that, but this is a cost for me to sell, right? So is that considered a recurring or a non-recurring allowable cost to sell? The answer is, it's recurring. Why? It's maintenance to the property. I own the property. It's stuff that should have been done or could have been done beforehand. It's ongoing, regular, allowable maintenance to the building, which means it's a non-allowable recurring cost to sell and cannot come from my sales proceeds. Okay, that's scenario number one. Here's scenario number two. You're going to take my listing. You tell me all these things need to be done to the property, and I tell you no. Sell it as is. Can I do that in the state of California? The answer is yes. But the bottom line is I have to disclose it. So I do. So the buyer comes in with a full market offer. And you tell me, Phil, this is a really good deal. Take it. They're just telling you, you have to fix these things or credit them back, and they'll do it. So I decide to accept the offer. Now, my question is that still a non-allowable recurring cost to sell, or is it considered a non-recurring cost to sell? The answer is, it is no longer a not allowable recurring cost. It's now a non-recurring cost. Why? Why is it not allowed beforehand, but it is now? And the answer is because it's a contractual condition of sale. And when it's a contractual condition of sale, it is allowable because you agreed via contract to do this for the buyer, and the buyer requested it and you said it was okay. And that's the difference. It's contractual versus non-contractual. Does that make sense? And that is allowable. So let's see, I thought I saw a question here someplace. Oops. Let's see if I can find it now. Aha, there it is, question. If there are two people on title of the income property that will be sold, can they both purchase separate replacement properties in a 1031 exchange, or does title have to remain the same? That is a really, really good question. And I'm going to touch that in a couple of slides. So if you can just bear with me, I want to get to that part because I've got a few comments to make about it. Because there's a big, big if, and I'll talk about the if in a little while. So if an anonymous attendee who sent me this, I will answer that question, but just hang in there with me for a few minutes and I'll get to it, all right? Next, Navira. What if the sellers give credit up front for any repairs? No problem. As long as the seller gives the credit to the buyer, you, the seller who's exchanging, you give that to them as a credit, or you do the work yourself. Either way is fine. All right? Good questions. Next. Oh, we already did this. Can I keep money when I'm exchanging? The answer is no. All the above are taxable. Number one, improvements into the property. We already talked about that. You can't hold back money to put into your property later. It has to go into the acquisition. Number two, money spent preparing the property for sale. We just talked about that. The answer is no, that's taxable. Number three, general cash for vacation or bills. The answer is no. You can't do that. The government says all the cash from the sale has to go into the acquisition, not for general cash, not for bills, past bills, or vacations. Forget about it. Number four, over borrowing. This is a big problem. And I want to bring this out. Please warn your client that when they buy the replacement property, that the lender pays attention to what was paid off on the sale of the relinquished property in terms of debt. because if they overpad the new loan and there's money left over in escrow because the client overborrowed, they get that money back. And guess what the government says? That money is taxable. Not only are they going to pay interest on that money, they're going to pay tax on it as well. So don't overborrow. That makes sense? It's really important, and that is a common mistake, and people are flaming mad that they have to pay taxes because the lender over padded the loan on the acquisition. There was money left over. So the lender has got to be working with the escrow officer on the acquisition on the estimated closing cost to make sure that they don't overborrow. Now, look, if you have an extra $500 or $400 or $300, that's different. You know, you pay a little tax on it. It's okay. You did a really good exchange. But if you go $5,000, $6,000, $7,000, $8,000, and they're going to pay taxes on that money, they're not going to be happy, because I've seen this happen too many times. So we try to emphasize this. Okay, I see I just got a few different questions. Vera, will we be able to get this offline in case we miss something? Yes. If you will hang in there, at the end, you'll see my email address and my phone number. You can request whatever you like, and I'll be happy to share it with you. I'll even give you a copy of this PowerPoint, but it's going to cost you. Please don't share it with anybody. It's only for you in your own study. Please don't give it to my competition. I've worked really hard on this. This is the best presentation I've ever seen of all the ones I've seen out there. This one is the simplest. It gets right to the point. It deals with every single topic that needs to be dealt with. So I will give it to you, but please don't share it with anyone. So you can have it. Mary, what cities or states are you seeing people exchange if they are selling in California? I see a lot of different things. I see Boise, Idaho is huge still, very big. I see a lot. Arizona is becoming more and more popular, parts of Arizona. I'm also seeing Texas is still pretty attractive to a lot of people. Boy, you know, it's really hot. Nashville and Franklin County and all those areas around there, they're going crazy up there. They say it's the new Los Angeles, but it's nicer. I see other places where investors are moving their properties. Nevada is another one. Out by Carson City and Reno. Reno is changing. It's every time I used to think of Reno, I would think of some old woman in her wheelchair with a cigarette hanging out of her mouth, and the ashes are this long, with her drink, pulling on a slot machine or something. A smoke-filled casino. That's what I would think of when it comes to Reno. But the bottom line is that Reno is really turning. You know who's moved over to that general area? Google's building some huge spaces. Amazon, Apple has built some spaces. Who else? Oh yeah, Tesla. I mean, they're developing their batteries out there. They are creating so many jobs, and so many people are moving to Nevada. Like that, I've seen a lot of exchanges going in that direction. So I hope that helps you, Mary. I think I've got everybody's question up to date here. Okay, next. Earnest money deposit. Where does that money come from? Well, it can come from two places. It'll come from the client, or it'll come from us, the accommodator. If it comes from the client, that means we don't have the money yet. They haven't closed the sale. As soon as the sale's closed, the money will be wired to the bank. And that's very important. So now that we're holding the funds, the client can request in written authorization for us to move X amount of money at this particular day to this particular escrow company as EMD for the acquisition of a replacement property. No problem. We can do that. But if the sale hasn't closed yet, we're not holding the funds, then they would write a check themselves to the new escrow company for the EMD. And then when we go to close the purchase, we'll instruct escrow, giving them the cash, to make sure they reimburse the exchanger the EMD they took out of pocket. So EMD is definitely allowable if it comes out of your pocket from the proceeds of the cash. because it's just a float into the acquisition. And but if the accommodator is already holding the money, the accommodator should be able to do that. If they say no, then you're not working with a very good accommodator. How safe is your money with an accommodator? This is really, really important. You have to check it out. If you're just using any accommodator, I want you to put the scrutiny to them with these. Number one, not co-mingled. Single client trust account or an escrow type account that is not co-mingle. Why would an accommodator co-mingle funds? I'll tell you exactly why. It's because they're going to make more interest off the float for themselves by putting it in one account. That may be good for the accommodator, but that's not good for the client. It's so easy to steal with the fraud that's going out there with escrow companies, banks, accommodators, title companies. Fraud is going through the roof. Folks, you don't need a gun to steal anymore. You need a computer. And I'm telling you, not only are people from the United States going crazy on stealing from financial institutions that are holding money, but people all over the world are logging in to try to get that same money. So be careful. Do not work with somebody who's giving one account and commingling your client's funds. It's dangerous. And then they may name you in a lawsuit for doing that. Number two, make sure whether they're going to put it well, make sure it's a non-commingled account. But that money that sits in that account is not in a corporate account of the accommodator. It needs to be in a client trust account. There is a huge difference. You see, the corporate account means that money belongs to the accommodator. The trust account means that money belongs to somebody else, but in the name of the accommodator, but it's not the accommodator's money. That taxpayer's money should never be in a corporate account. Be careful. Number three, the taxpayer should execute an authorization to release funds in writing for the account. In other words, this is more important than bonding. I'm telling you, it's more important than bonding. Though bonding is very important, you should never, ever allow the accommodator to just move money verbally. And there's still accommodators that do that, for crying out loud. You should be able to sign an authorization that says how much goes, where it goes, and when it goes. And if you don't sign it, they can't move the money. That's really important. I'm getting emotional here. Excited. But it's just common sense. You got to protect the client's funds. That money should never leave that account without the express written authorization of the client. Number four, bonding, E&O. It doesn't have to be a tremendous amount of bonding. 1, 2, and 3 are so, in some ways, it's just so much more important. And then in bonding is too, don't get me wrong, but the bond is going to, by the time they pay it off, it's too late. Your exchange is going to be invalidated. You're going to miss your timelines. So it's really important to make sure 1, 2, and 3, and 4 are implemented. And then ultimately, number 5, internal legal counsel. Some say that they have, attorneys, but they're in the title end. They're not really in the exchange end. That isn't what they specialize in. You want to make sure that you have in-house counsel that specializes in the 1031 exchange. Now, there are some very good companies that do this, folks. And there are some companies that should never be able to do business based on these qualifications. So just be careful that now I just happen to know one company that does it right? But the bottom line is, in all seriousness, check it out. Make sure that you're dealing with a very, very good, strong company that's well-funded. So what's a qualified exchange? Oh, I don't remember if we had any questions here. When acquiring a loan for a replacement, can it be a short-term loan? The answer, yeah, that's not a problem. It doesn't matter what it is, as long as it's a replacement loan or replacement cash. And that's all the government cares about. Good question. Here, Number one, can I exchange into a property I already own and do improvements? No, you cannot put money into a property you already own in a 1031 exchange. Not allowable. Can I, if I have vacant land, can I build a building on it and do a 1031 exchange that way? The answer is no. You already own the land. It's the acquisition of a replacement property. You're not acquiring anything. You're just taking money from a sale to build on property you already own. It is not qualified. Next, can I pay off a loan on a property that I own, such as my home or another rental that I have when I do a 1031 exchange? The answer is no. It has to go into the acquisition of new investment property for you. Number three, can I purchase property from myself when I'm selling from a corporation or another entity that I own? So in other words, if I have an entity and I'm selling that entity under a different name, like an LLC or a partnership or a corporation, can I buy one from myself? The answer is sometimes, but mainly no. You have to be careful because there's a lot of different tax things that have to happen, like you can't be a majority owner of the entity. There's a lot of different things that you have to go through with a really good a tax attorney and or a very, very sophisticated CPA. So be careful. You really can't buy from yourself, even though it's under another entity, but there may be one or two exceptions in there, and we've seen the exceptions happen, and they're legitimate exceptions. You just have to make sure you have good tax counsel to get you through. Anonymous attendee, when acquiring for a loan replacement, can it be short-term? Oh yeah, we already answered that. Oh, another one. I own an interest in a commercial rental property and want to buy out the owner. Does that qualify? That is a really good question. That's my next slide. In fact, this answers, remember I said before, I've got a slide coming up later on. This is the slide I was referring to. So this is the pinnacle of it. Must the replacement property vesting stay the same as I purchase within an exchange? It depends. The first question you have to ask is, the property I'm selling, who's on title? What entity's on title? Is it an LLC? Is it a corporation? Is it a trust? Is it a limited partnership? Is it tenants in common? Is it joint tenants? Who owns the property? And must the vesting stay the same? Now I want you to look at the bottom line on this slide. The government does not see you as a name. They see you as one of three things: a social security number, or a TIN number, or an EIN number. When you file your tax return, they're looking at the number, not the name. I mean, they consider the name, but it's the number that they have you recorded by. So if the vesting has your tax ID number in it, so for example, my wife and I own, let's say we have a rental, and let's say it's in a trust, our trust. And let's say we're selling the property and we want to do a 1031 exchange. And the property we're going to exchange into, the lender won't let us take title in our trust because that lender doesn't do that, and half of them don't, roughly. The question is, can we buy it as husband and wife, as community property, and satisfy the exchange because the vesting is completely different? One is a trust, one is our names. And the answer is, close my window because I guess the neighbor's gardener is there and it's getting noisy. The answer is, yes, it would be the same. Why? Because our trust has this, our trust tax ID number is both of our social security numbers. Therefore, the social security number of what we're selling is our social security number. And when we buy as husband and wife as community property, it's still us. It's still the same social security numbers. So when we report that, we report it on the same tax return, and the government sees, even though the entity changed, the tax ID number that sold was the same tax ID number that bought. Does that make sense? Now let's go with cooperative, where we have multiple owners. Let's say you and I own a piece of property together, Miss Anonymous, and that was her name on the question. And you and I own the property as tenants in common. What that means is we can go separate ways because we both own a fractionalized interest in the property. So we can sell, you can go your way, I can go my way, I can exchange, you could not exchange, it doesn't matter. It gives each one of us our individual ability to do a 1031 exchange or not to, whichever that individual chooses to do. But if you and I, Miss Anonymous, own it in an LLC, we do not own the property. The LLC owns the property. Why? Because I started an LLC for the purpose of limited liability. I don't want someone to sue us. They can sue the LLC and take the property, but they can't come against us and our personal ownership of other items of properties and assets. So if it's in an LLC, the LLC has its own tax ID number and files its own tax return. Therefore, that LLC has to buy the replacement property. Now, there's ways to get around it, but you're going to have to come back to the next, our advanced class, because we're going to show you how the government will allow you to manipulate it, but it's going to take a little time. And but I'll go and I'll explain it, and you'll get it. So the same is going to be true, by the way, with a corporation, a limited partnership. Corporation, you just can't dissolve, because once you do, it becomes taxable at that time, whereas an LLC has more flexibility to it. But again, these people should be working with their tax counsel on how to exchange if the entity is not itself exchanging itself. I hope that answers your questions. I hope that makes sense. And remember, you're not a name. You're a tax ID number, and the government wants to see that same tax ID number sell and buy. So it looks like I need to step it up a little bit, because we have about, what, another 5 minutes to go? I hope you're enjoying this class. I know that I am. Can I move into the, this is like the #1 question I get. I speak at 130 seminars a year. I think I might be speaking now more the last decade, more than anybody else in the country on this subject. This is the #1 question I get. #1, can I move into the property, do a 1031, well, can I do a 1031 exchange, rent it for a little while, and then move into it? I guess you could, but that's called manipulation. Now, the bigger question is, does the government agree with that? Here's the answer. You ready? Have your client check with their CPA. That is so important. Why? Because it's giving them tax counsel, and you don't want to do that. Unless you have a license to practice this stuff, folks, unless you're an attorney, forget a regular attorney, you need a tax attorney, somebody who really specializes in this, or a very highly specialized CPA, then don't even try to give them an answer. But between you and me, because I know a little bit about this area, I'd like to enlighten you on it. #1, anytime you do an exchange, remember what we said a number of slides ago? You have to buy it with the intent to hold for investment or productive use in a trade or business. That's what made it like kind. You sold investment property and you bought investment property. The key word of investment is hold, not to buy to move in. If the government feels that you bought it to move into it at a later date, they can say that's not like kind and go back and disallow your 1031 exchange and make you pay all the back taxes and all the interest on the taxes for all those years. So you better be careful and not give out this kind of information. Having said that, let's look at COVID-19. 2 months ago, everything was going okay. Families were intact, finances was intact, jobs were intact, but everything changed just like that. The government makes allowances for unexpected, unanticipated, unplanned changes. For example, marriages can fall apart, divorce can come in, death can happen. That's unanticipated. Bankruptcy, financial issues, like what COVID-19 is causing for so many people, that the government has to come up with all the stimulus money. That's unanticipated. That might be a good reason of a change that was not anticipated. How about a health change, for crying out loud? I mean, medically, anything could happen. Heart attack, cancer, whatever. Strokes. So in these types of situations where there's been no plan to have a disaster like this happen to your life, after 2 years of holding, you might be able to move in, but your CPA has to give you the approval to do that. Not you, the agent, or not me, the accommodator. This is not a 1031 exchange question. This is a tax and a legal question. You don't want to make yourself vulnerable, because the person who keeps telling you that they want a favor from you today is tomorrow's plaintiff in court, and you're the one who's going to be prosecuted. Not me, because I'm not going to tell them the answer. I'll give them some of this information I just did, but not give them a yes or no answer. Do not give them a yes or no answer. Like I said, there is some provision in the code after 2 years if something changes, but not with the intent to change. Does that make sense? I hope that answers your questions in this area. This is a very touchy subject. I had a really big commercial guy call me up yesterday, and he said, Phil, I know a lot about exchanges. You and I have been doing work for decades. He goes, but I couldn't answer this question. And here's the answer. That's the best answer you could ever give. Hope that makes sense. Okay, now I want to talk to you about a conversion rule. Oh, we just had Easter, right? What is a conversion? Is this a conversion? Yeah, it is, but not that kind of conversion. A little exchange humor there. Not very good, maybe. But the question is, can you convert a non-primary residence into a primary residence? And does it change or reduce the amount of the personal property exclusion under Code Section 121? Here's the answer. Be careful, be careful, be careful. This is what happened. In 1988, oops, hit the wrong one. In 1988, the Congress back then created a new law, a conversion law. And what it did is they called it the Housing and Economic Recovery Act. Now, does that sound like it's supposed to be a good thing or a bad thing for you? Well, it sounds like it's supposed to be a good thing, but this is what they said. If you convert a property you already own, this is not a new purchase. This is something you own, like a second home, a vacation home, a rental, and you decide to move into it and convert it. They said it's okay because you've had it for all these years. Remember, this is not a 1031 exchange into it and then converting it into your personal residence thing. This is not what they're talking about. So it's been a rental for a long time, or a second home or a vacation home. You know, and you decide to move into it and live in it for 2 years. Then you want to sell it and take up to 500 or 250. They changed the rules, and this is what they said. Nope, that's not it. I thought I had another slide with that. They said that they're only going to give you a part of the 121, a part of the 250, or a part of the 500, depending on what you qualify for, if you're married or not married. And it's going to be prorated beginning with the usage of that property beginning January 1st, 2009 till the sale date. So they're going to look at what they call the non-qualified years beginning 2009 that you owned it as a second home or a vacation home or a rental versus the amount of time that you actually lived in it. And then they're going to come up with a ratio and give you that ratio off the 250 or the 500, which means you're only going to get this much of it. That's why you got to be careful and not give this kind of tax advice to a client. To say, yeah, just convert it to principal residence, live in there for 2 years, sell it, you automatically get 500,000 or you automatically give 250. Bad, wrong information. Don't do that. All right. Can I combine a 1031 with the 121? Yes, but we're going to have to save this for another time, maybe when we do the next class, because our 2 hours are up, I can tell. And I don't want Nikki mad at me because I really like her and I want her to invite me back again so we can come back and talk more about this. Can I carry back? And then we're going to talk about that. Can I carry back when I sell my relinquished property and not pay taxes? I'll talk about that next time. If my exchange fails, am I eligible or for money back according to the IRS? when do I get my money back from the accommodator? We'll talk about that next time. Lastly, we have marketing letters that we have that deal with cash flow, that deal with, how to decide how do I calculate, what's my rate of return on my property based on my cash on equity return. It talks about all kinds of other things. I have between 12 and 18 different marketing letters that I would be happy to give to you. If you send me an email, you can see my email address on there, philatwan@gmail.com. The board has it. Nikki has it. You probably have it because I've seen you a number of times, philatwan@gmail.com, or call me. But more importantly, I would prefer that you would email me asking me for these items. I'll be happy to share them with you under one condition, especially the marketing letters. You promise me you're going to use them. Remember what we said at the beginning? 80% of what you do is showing up. If you can just show up and start discussions with people who own multiple properties, and you can get these properties from your title company. Your title rep will provide you these absentee rental owners, including, I have a letter for out-of-state owners. You know how many people own property right here in the South Bay who don't live in the state of California? How about an exchange to bring something closer to where they live, so they can keep an eye on it? We've got all kinds of marketing letters for you that I think could stimulate some new conversations and create new relationships for you. But I hope you stay safe and healthy and wise. And I hope that you can utilize and create new relationships in this time of disaster to turn it into something good. Because there is opportunity in every difficulty. You just have to find it. And I'm hoping that this will help you. Thanks, everyone. Thanks for having me. I'll look forward to your emails or your phone calls. Have a great weekend. And we'll look forward to the next time we meet together on Zoom and ultimately our advanced class. Have a great day. God